I'm going to go over stock valuation in the next few videos. So a lot of people want to take finance and apply it to calculating the price of a stock, which is a very practical thing to do. Now, there is a formula. There's multiple formulas that you could use to create that, but you'll see some variability, and we'll get through that. Now, before I get to that, I'm going to talk about the concept of enterprise value. Enterprise value is basically the total value of a company. So it's people sometimes confuse it with equity. That is not the value. It's what's the value of the business as a whole. And enterprise value is equal to the total amount of debt that the company has outstanding and the equity. So if you take all their common shares, if it's a publicly traded company, and see what the market value of those common shares is, and then you add that to the market value of all of the debt that's outstanding that they've taken on, that would be the enterprise value. A lot of people think it's the value of the company is equity minus debt. Conceptually, you think, well, I take off the debt because I owe it, but that's not correct. It is equity plus debt, and it's easier to illustrate this with the example of a house. Okay, so if you look at a situation where you're going to buy a house and it's worth $500,000, and let's suppose you want to take a mortgage of $400,000, and as a result you're going to put a down payment of $100,000 on the house. So we're going to equate the house to a business, and if you look at each one of these three components of what I've described, the mortgage is obviously the debt associated with the house, and the down payment is your equity. So what's the value of the house? Most people would get that pretty straightforward. The value is going to be the $500,000, which is the debt plus equity. And the exact same concept applies to corporations as well. So how do you value the enterprise value, or how do you calculate the enterprise value of a company? Now, there's going to be subjective variables and all that, but we're going to go over a couple of different models. One of them, commonly used, partly because it's very simple, is called the dividend growth model. The second one that's often used is the multiples approach. This is also relatively straightforward to do. And the third one is probably the most accurate, but it takes the longest to do. It's the discounted cash flow approach of valuation. So I'm going to go through each one of them, and let's start with the dividend growth model first, since that's the easiest one to do, and it's one that you'll often see quoted for public companies. So in this case, the formula is that the enterprise value, or really the share price in this case, you're not talking about the enterprise value, it's going to be the dividend in 1 year from today. So dividend 1 is 1 year from today, what the dividend per share would be for the company, and divided by R minus G. And R is essentially going to be the expected rate of return that an investor wants to get on the stock. So that rate is going to vary depending on the risk of the stock. So the riskier the stock, obviously you want a higher return. And G is the annual growth rate that's expected from this company. So you're going to expect it to grow at a certain rate. Now in this case, it assumes it's the same growth rate every year forever. So it may not be realistic, but it's a nice simple assumption. So again, this really isn't enterprise value. This is the price per share that we're going to calculate. So it's going to give you an estimate of the equity. So you take the dividend per share, which is public, but you divide it by R minus G. R is an estimate, G is also an estimate, and that would give you the estimated share price that the stock should be trading at. So there's some pros and cons to this. Basically, the pro is it's relatively simple to do. You make a few estimates and you can get it done, and you're going through the equity value here. The problems why this isn't the only one ever used is sometimes you have companies with no dividends, and it just doesn't work. And secondly, both growth rate and the expected rate of return are estimates, and the growth rate is not the same forever. So these are pretty significant assumptions. So if you were to consider that the variability of some of these assumptions will cause a variability of the stock price, basically means you can have a wide range depending on what you assume. So it's not necessarily the most accurate.